Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks pushing higher here. Wall Street digesting fresh labor market data and keeping a close eye on Fed rate cuts and Fed independence. We're digging into those headlines. But right now, there's just an hour to go until the closing bell, and stocks are in the green. The Dow tacking on around 300 points here. The S&P 500, your broad gauge, is up about 0.6%. Your tech-heavy NASDAQ up about 0.7%. Let's welcome in now. We have Fed correspondent Jennifer Schonberger. We've got data and markets editor Jared Blickery joining us to break down all the headlines. Jared, my friend, we'll start with you on today's trading action so far.
As you said, we are in rally mode right here. Dow up just about 300 points, or 0.2%. And the NASDAQ and the S&P are pretty close to the same upwards percentage terms. And you can see we started out the day in slightly negative territory in red, and now we are pretty close to the highs of the session right now. Very similar chart in the NASDAQ, although definitely at session highs. And the S&P 500, there you go, looking pretty similar to those two. We'll also check in on the small caps, which are just a little bit higher than the other two. You're looking at 77 basis points, or 7.8%, and it's just been from the lower left to the upper right, kind of stair-stepping higher today, what you want to see in a nice September rally. And let's check in on the bond market. We had a huge day yesterday, and today's price action is a little bit more muted. We saw a big drop yesterday. We're seeing some follow through today in the 10-year. That is down 3 more basis points to 4.18%. Then you take a look at the 30-year. That is down 1 basis point to 4.88%. After the biggest drop since August 1st, but that happened yesterday. Meanwhile, the US dollar index, that is up just a little bit, but nothing to write home about. And let's take a look at this sector action. Pretty interesting leadership today. Consumer discretionary. This has been a day about retail, and we have some smaller players, but Amazon has been driving the bus here. XLY, that is consumer discretionary sector, that is up 1.5%. Followed by financials and industrials, communication services, energy, all of these outperforming the S&P 500 right here. And to the downside, we only have staples and utilities in the red. And if we take a look at the NASDAQ 100, we see all the mega caps, all the Mag 7, plus a few others in green territory. And there's Amazon up 4% right now. Meta, which is in communication services, that was leading yesterday with Alphabet, that's up 1.5%. Netflix is in comm services too, that's up 2%. So looking at the broad array of different sectors here, and I'm going to go to my leadership board for this, you can see a pretty vast swath of bullishness. In the upper left, I have XHB. That's my home builders ETF. So we got home builders leading the way. Then we have XRT. That's retail. IPO. Guess what that is? That's IPOs. Small oil, cannabis, solar, Mag 7, chip stocks. You put it all together, that's pretty broadly bullish. To the downside, we are being led down by Bitcoin, and then China, and then biotech, also software. So not all of tech is in the green right now. Here's software. You can see a lot of red. Salesforce probably leading down there, although Shopify up 3%. And I did want to show our retail board because we're seeing a lot of participation here. Look at all the big boxes in the green. Shopify there again in up 3%. But I want to show you apparel because I haven't seen this in a while. We're seeing American Eagle Outfitters, that's somewhere there, 35%. I'll just show that real quickly. 35%, you can credit the denim fad for that, and a lot of follow through in some other stocks. I think we're going to get Lulu news after the bell. That's up 3%, boots up 5%. So apparel, really one of the leading industries today.
Yeah, some big earnings on deck, Jared, for sure. Meanwhile, Stephen Miron, President Trump's pick to join the Federal Reserve Board of Governors, spent the day testifying before the Senate Banking Committee. The confirmation hearing for Miron, who currently serves as chair of the White House Council of Economic Advisors, comes as Trump moves to gain control of the traditionally independent central bank. Jen, what are the key highlights so far?
Josh, it was a heck of a hearing. In a heated hearing lasting roughly 2 hours, Stephen Miron pledged that he would act independently if confirmed as a governor to the Federal Reserve Board. However, he said he would not step down from his post as chair of the President's Council of Economic Advisors, only taking a leave of absence.
I have received advice from counsel that what is required is an unpaid leave of absence from the Council of Economic Advisors. And so considering the term for which I'm being nominated is a little bit more than 4 months, that is what I will be taking. As long as that is the advice of counsel, I will follow the law.
Well, Your independence has already been seriously compromised by your statement. You are going to be technically an employee of the President of the United States, but an independent member of the board of the Federal Reserve? That's ridiculous.
Myron said if he were to serve a term that was longer than 4 to 4.5 months, then he would resign. His comments coming after he penned a proposal for the Manhattan Institute back in last March, in which he said he would propose a ban on what he called a revolving door between the Fed and the executive branch, saying that he would prefer that any member of the Fed wait 4 years before serving in the executive branch. Now, meanwhile, both Democrats and Republicans hitting Myron hard with questions about Federal Reserve independence. Senate Banking Committee Chairman Tim Scott, in particular, asked Myron whether he would affirm his pledge to uphold central bank independence, given what he told him in previous conversations.
The independence of the Fed. I think the Federal Reserve needs to remain quite and completely clear in its independence. Certainly, as I said on the call, you share President Trump's vision for what it takes to move our economy forward. But I want to make sure that the answers that you gave when we were talking are still the answers that you have now as it relates to your role as the governor of the Fed and not as the chairman of the CAE.
I couldn't be more in agreement that independence of the central bank is of paramount importance for the economy, for financial markets, for the long-run stewardship of the country. All of those are completely, I'm in complete accord with. Look, the president nominated me because I have policy views that I suppose that he liked. If I'm confirmed to this role, I will act independently.
Meanwhile, ranking member of the Senate Banking Committee, Senator Elizabeth Warren, a lawyer by training, tried to test Myron and how independent he would be on the Fed with a series of questions, including whether President Trump won the 2020 presidential election, to which Myron responded repeatedly when questioned that Congress certified that Biden won. Warren said that he had failed her test. Meanwhile, we expect a vote out of the Senate Banking Committee as soon as the middle of next week, setting up a vote in the full Senate shortly thereafter. Josh?
All right, Jen and Jared, thank you both. Appreciate it. Well, for more on Stephen Myron's confirmation hearing and the Fed, we have Daniel Altman, author, an economist of the weekly newsletter High Yield Economics. Daniel, good to see you. So you were listening to Mr. Myron on Capitol Hill today. What'd you make of what you saw and heard, Daniel? What were your takeaways?
Well, Stephen Myron is obviously a very clever guy. He has the same PhD that I do with some of the same advisors. But what I heard was a lackey, honestly. I thought that for a guy who was talking about the independence of the central bank from politics, all of his answers were extremely political. He didn't make any statements about economic policy itself or what his views were on the dollar or interest rates. He just seemed much more concerned with not offending the president. And when he actually was asked whether the economy would be in better shape if the president could set interest rates unilaterally, he refused to say no. So how does that square with Fed independence? I just don't get it.
So, Daniel, as you noted, listen, serious guy like yourself. He's got his PhD in economics from Harvard. Pretty impressive. I mean, part of this, Daniel, isn't it? Listen, he's on a job interview right now, right? And it just happens to be an interview before a live national audience. And like a lot of people, when they're in a job interview, he's being careful. He's trying to avoid the landmines. He's trying to say what will get him the job. So isn't that sort of the caveat as we watch all this?
Well, I think he's already got the job. I don't think there's much doubt about his confirmation going through. This was just his chance to respond to senators' concerns. And I thought that he really gave almost zero of substance and ended up contradicting himself many times. I've seen many Fed governor confirmation hearings, and this had to be the one of the least substance that I'd have ever seen.
Do you agree with Myron that rates should be lower?
I don't necessarily agree, even though we've seen a market dip in the job creation and the payrolls numbers, and we've seen lower economic growth. Both of those are consistent with a falling labor supply, which is what we've had this year. Between January and July, the civilian labor force has dropped by more than 400,000 people. And when the labor force is shrinking, you don't need job creation to keep the labor force in equilibrium, the labor market, I should say. The unemployment rate has barely changed in the last 12 months. And so this is just exactly what you would expect if the labor supply is shrinking. So it doesn't make an argument at all for lower interest rates. In fact, you could argue that the economy is still very close to full employment.
So the market, Daniel, I mean, it thinks cuts are on the way. It thinks that cut is a lock. Would you suggest, maybe the market needs to reconsider that confidence?
Listen, I think that the Fed has been looking at the data and they've been considering the overall situation, and they might decide they want to get ahead of things a little bit, maybe throw the market a bone with a quarter-point rate cut. But I don't think that they're necessarily going to cut as much as the markets expect. If you look carefully at Powell's speech at Jackson Hole, he made reference to the neutral rate of interest, which is the rate of interest where his policy is neither restrictive or particularly accommodating to credit markets. And he said that that neutral rate is higher than it was in the 2010s. That means that he doesn't have to cut that much to get down to that floor. And I think that that floor may be higher than where the markets think it is. And also, I just see reasons mounting up for these cuts not to be in a hurry. We see continuing pressure on prices from tariffs. We now see retailers starting to raise their prices much more broadly, which is taking advantage of the back to school season. And they will, of course, again in the holiday season. So, all of this is portending fewer cuts than the markets probably expect.
So tomorrow, Dan, I'm curious, with that big jobs report on deck, what are your expectations? What are you going to be looking for?
I don't expect to see a lot of job growth, to be quite honest with you. We've seen some increases in retail sales and things like that, but a lot of those are mechanical just because of higher prices. People trying to get ahead of tariffs and price increases that they anticipate. We don't really have particularly big reasons for huge job creation right now, as I said, with the labor market shrinking. So I wouldn't be surprised to see another kind of lukewarm number. But those lukewarm numbers just don't mean the same thing now as they do when the labor market's growing and the economy is surging.
And here, Daniel, talking about all things Fed. As you know, there's been questions raised about Fed independence. I'm curious to get your thoughts on that.
The independence of the Federal Reserve and any central bank in any country is really paramount for keeping inflation under control. It means that political forces can't try to push interest rates down just to juice the economy. It means that the central bank is keeping its eye on the long-term picture and trying to keep inflation expectations anchored. And that is what we need to continue to have low inflation and a stable economy that's able to give us full employment and productivity. Mr. Myron said that he believed in that, but a lot of the other things he said tended to call it into question.
Daniel, we will leave it there. Thanks so much for your time today. Appreciate it.
My pleasure.
We are just getting started here on Market Domination. Coming up, anticipation around Apple's big event peaking, and the company's stock may be benefiting from the hype. Plus, AI chipmaker AMD slipping. Stay with us. We're going to explain why. And networking equipment company Ciena spikes as it announces layoffs. We'll explain everything you need to know. Those stories and more coming up. Stick with us. AI-related names under the microscope as Wall Street combs through growth prospects in the artificial intelligence trade. This earnings season uncovering pockets of opportunity and clouds of concern for the AI arena. And here to dissect the stages of the AI growth story, we have Spear Invest founder and CIO Ivana Delaevska. Ivana, great to see you as always. We've had some analysts, Ivana, tech analysts, and we asked them to sort of break down how they see the AI trade and trend and where they see opportunity. Some of them come on the show and say, actually right now, it kind of just feels like 2024 all over again. What they mean is, they say it's just all about the AI infrastructure names. That's where people are placing their bets, whether it's NVIDIA or it's the Microsofts, it's the Oracles. It hasn't been a win, they argue, for the applications yet. Is that how you are kind of seeing the divide right now?
That's right, Josh. So I think it's been going in waves, and there was a first hardware wave that it was happening about 2 years ago, and now we're ahead of another investment wave for hardware and infrastructure. So this is why everybody is excited about the hardware layer and the infrastructure layer more so than the application layer. The application layer will take much longer to develop, but once
we mean years, Ivana?
Yes,
what are we looking at?
Absolutely. So I think it's going to be years. And even companies that are already large scale, like Salesforce, they're launching AI tools, but even for them, it's taking a very long time to scale. So watch the application layer, but in terms of investments, the risk reward is really more on the infrastructure side.
And when folks, when they ask you, and you've been investing in this space for a long time, there are questions raised about where is the ROI on all of this AI investment. You say what to them?
Well, the data center space, specifically the chip side, the networking side, this is where you're going to find the best ROI. And the reason is because these companies don't need to make significant capital investments to deliver returns. Like NVIDIA is investing in R&D, companies in the networking like Arista Networks, they're investing in R&D, but those dollars are much smaller than the billions that the cloud service providers need to invest in order to keep up. So from our perspective, we're very focused on returns on invested capital, and this is why the chips, networking are really attractive areas, more so than the cloud service providers.
Speaking of the chips, Ivana, you got Broadcom after the close today. That's a name investors have piled into. It's up, Ivana, around 100% off that April low. How important is that print, in your opinion, not just for Broadcom, but this broader AI trade we're talking about?
So it's very important. Every data point that we get, we pay close attention to. So the networking players have been coming up with very strong numbers, like you had Ciena and Credo today, with really strong numbers. Previously, there was Arista Networks, Astera Labs. So the networking numbers have been pretty spectacular. The questions for companies like Broadcom and Marvell are how they're going to do on the custom chip side. So that's something that hasn't really played out as well as we would have expected this year.
Why
in
is
terms
that,
of,
Ivana? Why?
I mean, you've
heard the competition. Is that it? Because you've heard them talk
exactly
about kind of
what
lumpiness.
Yeah, that's exactly what it is. So it's very hard to compete with NVIDIA. Basically, you need to find customers that are willing to build on top of your chips rather than NVIDIA's chips come with pre-built frameworks. So if you have somebody like Anthropic, they're building on Amazon and the Trainium chips, but you really need to find customers that are willing to do that. Most customers, especially like newer startups, they don't really have the resources to do their application and then on top of that develop kind of the middle between the chip and the application. So that's the reason.
You mentioned some picks. I want to get those. Networking. Would Credo still be a buy in your opinion here?
Yeah, so Credo and Astera Labs, they are newer companies, or Credo has been around for a long time on the AEC side, but they're entering some completely new products and areas like PCE retimers. Those would be like tools that will clean up the signal. So there are just a lot of components that go into the networking system. So these are components that clean up the signal that are very important as companies build and improve the chip. So really the improvement from generation to generation is going to come from the networking side. This is why networking is one of our key focus areas for this year.
You also mentioned on some platforms, talking about Snowflake and Palantir you like.
That's right. So we don't own Palantir, we own Snowflake. We disclose all of our holdings on our website. Cloudflare is another one we really like. So these are platforms that either companies can use when they use AI, or they can use it to build AI tools. So what we love about Cloudflare is that there are platforms, so companies like if you're trying to build an AI application, that platform is a really good fit for you to build on. Snowflake would be a better fit if you're already like an industrial, let's say, or a pharmaceutical company or a lot of financial customers, and you're trying to build new AI tools. And use your own data, you can easily import it, share it with customers. It's very compliant in terms of how you can share the data. And then Palantir is...
You don't own Palantir.
We don't own Palantir.
Why not, Ivana?
It's mostly because of the price to earnings ratio. And
some have pushed back on Ivana. I have Palantir bulls come on. They say, yeah, okay, it's expensive, but they'll argue, get your take on this, it is a one-of-a-kind growth and margin profile.
Well, I mean, there are many one-of-a-kind margin growth profiles, right? So you need to pick what we do. What we do very well is we cover a universe of about 120 names, and we try to pick about 20 stocks that we think will be the winners, and that's what goes into our ETF. And the key is risk-reward, right? So while there is still a lot of reward potential in Palantir, there is a risk that the stock stalls if they can't put up the growth numbers that people expect, right? So at some point, if growth stabilizes, all of a sudden the multiple is going to look expensive. It doesn't look expensive per se right now. Like if you think they can continue this growth for 10, 20 years, right? So that's the bet that people are making here buying the stock. I think the risk reward is a little bit better in companies like Cloudflare and Snowflake because they're trading in the low 20s on a multiple basis, which if you double your revenue, all of a sudden it's closer to 10, right? So that's a little bit better risk reward. It's purely valuation and modeling driven.
I want to end here. You gave us a bunch of great names, AI winners. Who do you think gets displaced by AI? What are names you say, because of AI, I might avoid these?
Well, in the software layer, there is big disruption going on. People are getting fired. Coders are getting fired. Basically, what's going on is AI is able to displace a lot of technology employees as well as tools, right? So companies like GitLab are really prime for disruption, right? Because the question is going to be like, can somebody else just replicate this product easily? So I would say like the application layer, if you're looking for losers, that's where we're finding a lot of companies. Some of them will be able to come up with tools and reinvent themselves, especially if you have a large customer base like a Salesforce. Like you would think that over time they will be the ones that come up with an AI Salesforce tool that gains broad adoption. But really in that AI application layer, there is opportunity for disruption.
All right, AI winners and laggards. Ivana, thank you.
That's right, that's a better way to put it. Thank you.
All right, now time for some of today's trending tickers. Spear Invest's Ivana Delaevska, still with me here. I'm going to look at Apple. We're going to talk about Ciena, maybe a little AMD, Ivana. Let's go through these. We're going to stick here with Apple. MoffettNathanson upgrading the iPhone maker. From sell, they go to neutral, noting that the worst case scenarios are off the table. So listen, they go to the sidelines on this. They do say some of the headwinds have faded, Ivana. They talk about the antitrust ruling involving Alphabet. They say that was a positive, a pleasant surprise. They do emphasize that Apple remains expensive, they think. They talk about the AI challenges. Their target, $225. They remain on the sidelines. Are you on the sidelines?
We're also on the sidelines. I think it remains a show me story here. They're one of the companies where they have like close to 100% market share. Everybody has an iPhone, right? So they have the installed base that if they were to introduce something on the AI application side that is breakthrough, they can really win. But they haven't been able to do it yet, right? We haven't seen any progress, any iteration that they have done. It really looks exactly the same like the prior version. So there is really room here for a disruptor to come in, right? There is room for them to do something better. But I think from risk-reward perspective, we are on the sidelines.
What do you say about the bulls who tell me, you know what, I get everything Ivana's saying, but man, that install base, billions of devices, loyal, locked-in Apple fans, they're not going anywhere.
I mean, there is real value to that. I wouldn't necessarily argue with it, but there is also like the opposite side of somebody could come in and offer something that's different, right? So I think for us, like we do need to have a thesis that we can bet on, and there is really just no thesis that we can comfortably bet on here.
All right, with new iPhones on deck soon. Meanwhile, turning to Ciena, those shares soaring after providing a better than expected fourth quarter revenue forecast. Third quarter earnings revenue also beating Wall Street's estimates. We were just talking about this one, Ivana. So Ciena, maker of equipment used by telecom companies. Q4 revenue forecast beats, Ivana. Q3 profit and revenue, that beat. Evercore ISI, they weigh in. They say it's a shock and awe print, Ivana. Raised the target to 120. I saw BI analysts say the Q3 results and Q4 outlook, they show healthy cloud demand driven by AI. Most on the street are believers. You are as well.
Yeah, so we love Ciena here. I think it's a plays on that networking side that I was talking about earlier, where I think that's where a lot of the improvement will come from, and that's where a lot of the investment is going in. So AI data centers, that's one of the big growth areas for the company. There is also a margin story here, a margin improvement story. So that's how they're able to grow the bottom line as well in excess of the growth of the top line. And they also guided out pretty strongly. So as we look forward, they provided a lot of confidence on the conference call about where they're getting their confidence from. So I think it was a overall positive print, but as well the call was very
positive
strong.
print. Investors piled in. Lastly, a look at AMD. This one's interesting. Seaport Global downgrading that stock from buy to neutral. So this one, Ivana, all right, so Seaport downgrades Lisa Su's company. They go to neutral. They say recent conversations across the supply chain point to AMD experiencing slowing progress with its AI accelerator business. Makes it increasingly challenging for them, they say, to clear these high expectations this year. They say, yes, AMD, long-term competitor in AI, but they say the time frame for them achieving more meaningful share is further out. What do you think?
So I would disagree here a little bit, because I think that was all true about a year ago. Basically, when they introduced their first accelerator, there was a lot of demand. They got to $10 billion of revenue very quickly, and then growth stalled, right? So there was a period of time where they really weren't beating and raising that $10 billion number. Now what we're hearing from customers is a renewed interest. So I think there is going to be actually more people going to AMD.
You're an AMD believer, it sounds like.
Going forward. So yeah, we have a small position in AMD. We had exited it previously, and we revisited it at the beginning of this year.
Interesting. Ivana, thank you. Appreciate it. Coming up, got Hewlett Packard Enterprise beats revenue estimates driven by server demand. We're talking directly with the company's CEO about the firm's performance. Stick with us. Mexico is modernizing its markets with technology, NASDAQ tie-ups, dual listings, and eyes on fresh IPO pipelines. But with tariffs and trade tensions in play, is now the moment for U.S. investors to put money to work in Mexico? Let's welcome in now Jorge Alegria, Mexican Stock Exchange CEO. Jorge, it's great to see you, especially on set. We were talking just off camera there, Jorge, about Mexico. The performance there is tracked by the EWW. I got it up around 35% this year. What, Jorge, explains that move? How do you explain it? What's driving that?
Well, thank you, Josh. We have seen some diversification coming from international players. They are, after maybe 5 years or so of out or overweighted in the developed markets, the US, Europe, they are now moving back to emerging markets, and Mexico is being offering very good value. So I think it's not only international players, but also large Mexican local funds are now investing more in the local market as well. So that's why indices like BWW or the IPC in Mexico, those indices are up more than 30%.
You became CEO, Jorge, we were talking about a year ago, 2024.
Yes.
What changes have you made, Jorge, already at the exchange to make that exchange, to make that business more competitive?
Several things. One is, you mentioned it, technology. We are upgrading all the technology in the exchange, starting with the post-trade. So you need payments, settlements, dividends, custody. It may be a little bit boring, but it's extremely important. We need to be sure that all that works perfectly well. And so we are tying up with NASDAQ technology to upgrade all that systems. And also on the front end for derivatives trading, we are also upgrading with NASDAQ technology. That's on one side. On the other hand, we are doing also post-trade, but on the clearing side for bonds. So we have now a central counterparty for bond trading. And on the equity side, colocation services for international players to connect directly and trade more efficiently the Mexican stocks.
All right, nuts and bolts, but it works. Let's talk about another trend we mentioned at the top. Mexican companies interested in going public, Jorge. Dual listing, Mexico and the US. Explain that trend to us.
What happened is the IPO market has been complex for Mexican companies for the last years. We need to understand that in a 10% or higher interest rate environment. So many investors in Mexico or outside were just putting their money on fixed income, and I mean, you are making 10%, no risk, that's nice. Interest rates are coming down, so valuations are going up. For companies, is becoming more interesting to go public. And now there's always the discussion, so should I go to the US market, where it's a larger market, maybe I can get a better valuation? And also, the other question is, or should I stay local in the Mexican market where my customer base is located? The branding is, I'm a Mexican company. So what we have been talking to companies here is you can do both, right? You can list in the US, get the valuation, but you can also list in the Mexican stock exchange as well. And you are now getting the best of both worlds. And this is not new. We saw that in the 90s when ADRs were becoming very popular. So Mexican companies listing in the US and in Mexico to get the best of both worlds and allow also international trading to happen between both markets.
And how many, I'm curious, Jorge, how many Mexican companies that you know of in the IPO pipeline right now would you say are interested in this kind of dual listing?
We have a pipeline of 5 companies, and 4 of them are looking for dual listings.
The research and reports I read, Jorge, kind of characterize it as being sort of there's been a kind of a dearth of listings in Mexico in recent years. Walk me through why that is and what are the reasons for optimism you see ahead?
I think it's a cultural thing, it's education, and it's not only Mexico, it's pretty much all Latin America except Brazil, where companies are more used to go on leverage. So it's more like a debt economy, more than an equity style that you may see in the US or some parts of Europe. But that's changing, especially with younger generations now running the companies, fintechs and other new economy kind of companies that they are looking for capital. So the first layer we saw is private equity, big private equity funds investing, putting money in Mexican companies, growing them, and now what we are seeing is the way out for these companies is the listed market.
Let me ask you this, Jorge. The tension we see, U.S.-Mexico trade tension, tariffs, could that dent the number of Mexican companies that maybe want to take a public market plunge?
I think this, despite all these discussions, the Mexican market is up 30% this year. And I think the market and investors are seeing that this reallocation, these discussions taking place are going to be ending up on a very favorable situation for Mexico being a logical, close partner to the U.S. in terms of trade in the end.
Jorge, great to see you, especially on set. Thank you for your time.
My pleasure. Thank you very much.
Hewlett-Packard Enterprise beating revenue estimates driven by server demand. CEO Antonio Neri spoke with executive editor Brian Sozzi as the company doubles down on AI and hybrid cloud.
We had a very solid quarter. We posted record-breaking revenue with expanded profitability on a sequential basis. And that's without and with Juniper, which obviously make it stronger. So overall, we had a very strong performance, and that was driven by strength in each of the key segments we participate, which, we saw double-digit year-over-year revenue growth. We saw expanded operating profit dollars in each of them. And then in server and hybrid cloud, we also expanded operating margin. But what really excites me, obviously, is the fact that we see a strong pipeline. We closed the Juniper acquisition and position us for what I call the next HPE chapter, which is going to be all about networking, hybrid cloud, and AI.
What do you envision HPE's role in networking? Because you're going up against some really big heavyweights.
We're going to be a market leader. Our goal is to build the best networking business on the planet, period, end of story. That's the goal. And fundamentally now we own the entire technology IP stack in that layer of the technology stack, which means we own the silicon, we own the operating system, we own the infrastructure, we own the software, we own the services, we own the security parts related to networking. And so when it comes to AI, and depending on the segment you participate, particularly in the large build-outs, we are going to lead with networking for AI. And Juniper already has some very strong marquee customers. And with HP, we can open those doors to new markets where today they have no ability to compete. So that's a big opportunity for us. But then when you look at the campus and branch business, which is basically the on-ramp to digitization and eventually inferencing, we believe that's an opportunity for us. And both companies, Aruba and Juniper Mist AI, have tremendous momentum, and both are winning in the market. So when I look at our portfolio, we have an amazing opportunity ahead of us, and that's just networking. Think about networking integrated with the rest of the portfolio. My view, that's not only is going to increase the relevancy with our customers, but also increase the shareholder value over the next 3 years.
Antonio, you want to issue any public challenges to Cisco? I mean, you could here on Yahoo Finance if you want.
Well, look, they're already taking notice what's happening, but I respect every competitor. Not for nothing, they have been market leaders in many of the segments of the market. But the reality is that we have way more assets than they do beyond networking, and that's the opportunity for us. We can compete in the pure networking market, but the way we deliver that value to customers is not just through networking, it's through integration with server storage, a private cloud, and our GreenLake platform, which is a point of significant differentiation for us.
Done like a true maestro. You subtly got your point through. I know you're a competitive guy, just like those F1 folks on the grid there, Antonio. So when you have you talked a lot about on the earnings call about this investor day, this analyst day that's coming in October, and you really made it a point to highlight what Juniper has coming. So when we hear from the Juniper folks, when they hop on that stage, what does their product roadmap look like over the next 18 to 24 months?
Well, you have to wait for October 15, but I will tell you there are 4 key distinct segments where we have focus and prioritization of investments going forward. Number 1 is the campus and branch. And together, Mist AI and HP Aruba networking, we have what I believe the best solution for our customers across all verticals: hospitality, entertainment, healthcare, manufacturing, financial services, and the like. And that's because both companies took a very modern approach when it comes down to cloud native and AI-driven solutions. And you can see that through the announcements both companies made in the last 3 months. At HP Discover in Vegas, we announced HP GreenLake Intelligence. That's a framework where we bring agentic AI to everything across the company. And Aruba introduced the Mesh AI solution together with our OpsRamp observability capabilities. Juniper last week introduced the Mist AI agentic approach that extends from the campus and branch all the way to the routing business and in between the data center switching. So there, I believe, we will be a number 1 vendor down the road, and we are already number 1 in wireless, by the way. I think some customers and the street may not know that, and you can see that in the Wi-Fi orders intake. We saw this past quarter, we grew triple digits. So I believe there we have a very strong presence. And data center switching, Juniper had record performance. They grew double digits, high double digits year over year, and that's because of the AI pull-through. And that also benefit the routing business, because when you build these large AI data centers, you need to lay, the pipes, which is basically the leaf and spine connected to this large amount of GPUs, but then you need a router to interconnect with the rest of the world. And Juniper has done a great job providing an integrated experience. So those are 2, right? And then you have security. And security is very important both at the edge with SASE and then in the data center with firewall and the latest AI-driven technology. So we have a very complete portfolio, Brian.
Well, now I don't need to come to Analyst Day. No, I will continue to follow it. Antonio, before I let you go, this remains a very uncertain time on all things tariffs. I'm sure you saw the court's decision on President Trump's tariffs. If tariffs were to go away in mid-October, what would that mean for a business like an HPE?
Well, I don't believe tariffs will go away, are here to stay, and is a rebalance of the global trade. And we believe we have adjusted to the new reality extremely well. We communicated yesterday that the net impact of the tariffs were already announced or in the works is just 2 cents. I think for us, the most important aspect of that is to continue to rebalance our supply chain, to continue to modernize our processes, to be more efficient in our supply chain, and then ultimately see what happened with 2 very important provisions. One is the semiconductor 232, because that's an important aspect as you import commodities into the United States. Today, semiconductors are excluded. And then the USMCA agreement, which obviously is coming up for discussion sometime end of 2026. But let's remember that HP has a very vast and diversified supply chain. And we as a team have done a great job maneuvering around it and continue to deliver the value, which we saw to expand the profitability this quarter. And then ultimately provide a guide, I think is what the street expected. But most importantly, we're going to provide a framework how we're going to create value for the next 3 years in October.
Coming up, Apple will unveil its new iPhone lineup next week. And one analyst says to expect iPhone prices to rise for the first time in 7 years. More details on the other side of the break. Morgan Stanley predicting Apple will raise its iPhone price, adding that pricing is still an underappreciated growth tailwind. Here with more, we got our tech editor, the one and only Dan Howley. Dan, so iPhone prices going up?
We could see them rise between $50 and $100, according to some notes that have been going around. Basically, it has to do with either tariffs or Apple trying to goose some of the cash out of the newer design that we're expecting. We're expecting to see the iPhone 17 Air. This, according to Bloomberg's Mark.
Is that new skinny model?
It's supposed to be a little thin thing.
Short.
Yeah, it's going to drop some lbs as I'm trying to as well. Less cookies for me. But basically, this is supposed to be around 2 millimeters thinner than your standard iPhone. So, you know, it's supposed to have a cooler, more interesting design. Samsung did a similar thing where they released a thinner phone, and then after that, they used the learnings from that to roll out their new foldable.
Now, if I go thin like that, I go skinny. Is there a compromise in any way?
There could be. So there's the prediction that there'll be just one camera on it. People really do like having multiple cameras, especially since we're more used to that now.
Battery issue?
Could be a smaller battery as a result as well. We'll have to see if Apple's able to play with the software to get, you know, an equal to battery life compared to the other phones. But, you know, I think that's something that customers are really going to have to take into account. And, you know, this smaller design could also mean a higher price, not just for that phone, but for the others across the board. They haven't raised prices in quite some time. They've made some changes to memory SKUs to kind of change the price a bit, but they haven't actually made those distinct.
If you saw price, I mean, listen, everybody's taking their bets here, but let's say price is 50 to 100. I mean, does that dent demand in any meaningful way?
So it can. I think if people look at it as a lump sum payment, then yeah, sure. You know, if I'm looking at something and I say, oh, there's like a, you know, that there's the mental thresholds, those 49 versus 99. You know, once you go past those, for whatever reason, we freak out a little bit. But some analysts that I spoke to said, look, a lot of people still get their phones subsidized. They're still paying monthly for them. So in reality, that extra $50 over, you know, a year or two, it's not going to add up to that much. Ditto 100. So they may just say, all right, well, I'm paying a little bit more each month, so maybe I'll just go for it. But, you know, if you're a lump sum person, you don't want to have to be beholden to a contract, then it may give you a little pause.
Switching gears while we have you, another headline in your universe, President Trump meeting with some high-profile tech CEOs, a who's who, if you will.
A who's who, a menagerie.
Really? What did you make of that?
I think it's interesting. You know, this is for that Rose Garden ceremony, and I think, you know, this is kind of big tech continuing to try to appeal to the Trump administration, something they've been doing since prior to inauguration, since prior to the election. You know, they seem to have noticed the kind of sea change in what was coming as far as the election goes. Mark Zuckerberg, you know, kind of hooting and hollering for Trump. You know, then we had Tim Cook at the White House recently. Zuckerberg providing funding for the inauguration. Ditto, you know, CEOs from across the board.
Is it Dan, just as simple as, listen, I'm a tech CEO. I know Washington can have this enormous impact on AI to China, self-driving cars. It's better for me to be on their good side.
Yeah, it's definitely more of a transactional relationship, it feels, compared to, prior administrations. They're keenly aware of that. There's been reports that Meta's trying to start some kind of pact to deal with AI, and so these companies are looking for kind of a leg up when it comes to Washington and making sure that their own agendas move forward smoothly and that they're not hit by any potential
What would you
tariffs.
put the odds of any actual news comes out of this? Some tech CEO says, you know what, steps up to a mic, puts out a press release, you know what, 100 billion domestic manufacturing.
I mean, that would be interesting, right? We already had Tim Cook come out. They upped their
And Trump could say to
investment.
the other tech CEOs, look, Tim,
He just
look
did
at Tim, look
yeah.
at Tim. Right?
Well, look, they've all agreed to build out some kind of data centers. They're all spending billions. I think they're set there, but there's some relationships that just weren't great beforehand. Maybe they're a little bit better now. I'm thinking mostly of Zuckerberg. Trump threatened to jail him. So, it could be one of those things where he has to maybe give a little more. But I do think it'll be interesting to see if we do get anything from them during or after the ceremony. Prior to the ceremony, just because whenever these tech companies are next to them, they're usually making some big splashy announcement. Right, like I said, the gift that Tim Cook gave that came along with a couple of $1 billion. Nvidia just continues to be in the good graces of the Trump administration. They're a powerhouse. Google. We'll see. Microsoft still doing well with the Trump administration. So I think it'll be interesting to see if we actually get something from
the president, he doesn't mind a splashy announcement. He doesn't mind that. Sure. All right, thank you, Dan. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.